Hello and welcome to The Explainer. You've probably been hearing the term private credit pop up a lot lately. I mean, it's one of the fastest growing corners of finance, and it's attracting billions and billions of dollars. So today, we're going to demystify it. We're going to break down the potential rewards, the very serious risks, and arm you with everything you need to know before you even think about diving in. And that really brings us to the core question, doesn't it? Is this kind of investment the right move for your portfolio? By the end of this explainer, I promise you'll have a much clearer framework to help you decide for yourself. So, let's start with the absolute basics. What in the world is private credit? You know, it sounds super complex, but the core idea is actually pretty simple. Okay, so just think of a private credit fund as a sort of specialized bank. What they do is they pool money from investors like you, and then they lend it out directly to medium-sized private companies. Now, why would a company do this? Well, maybe getting a loan from a huge traditional bank is just too slow or too much of a hassle. In exchange for providing this much-needed cash, the fund, and by extension its investors, get to collect all the interest payments. So if these funds are really just lending to companies, why all the buzz? I mean, what's the big attraction for investors? Well, the answer really starts with the potential upside. And here's the headline number. Private credit funds are often targeting annual yields somewhere between 7 and 12%. Now, just to put that into perspective, that can be a huge jump compared to what you might get from safer, more traditional bonds. Honestly, this is the #1 reason this whole asset class has grabbed so much attention. But look, the appeal isn't just about that juicy potential yield. Because these are private loans, their performance isn't directly chained to the daily mood swings of the stock market. That gives you some really valuable diversification in your portfolio. And get this, many of the loans have floating interest rates. What that means is the rates can actually adjust, so your returns could go up if central banks raise interest rates. It's a structure that can give everyday investors a peek into the kinds of institutional-grade deals that were, once totally out of reach. All while giving you a potential hedge against inflation. Pretty cool, right? But you knew there was a but coming, right? A potential yield of 7 to 12% just doesn't come for free. In finance, higher potential rewards always come with higher risks. So now we have to talk about the catch, the really significant downsides that you absolutely have to understand. This right here is the fundamental trade-off. It's the deal you're making. In exchange for the promise of those higher yields, you have to accept two major risks. First is higher credit risk. That's just the chance that the company you loaned money to simply won't pay it back. And the second is illiquidity, which is a fancy word that just means you can't get your money when you want it. It is locked up tight. Let's dig into these risks. Illiquidity is a big deal. Your money could be tied up for 1, 2, even 5 years or more. And during that whole time, you're exposed to credit risk. If the economy takes a nosedive, some of those companies might default. And what makes it even trickier is that the valuations are totally opaque. Unlike the stock, there's no public market ticker telling you what your investment is worth every day. It's all based on internal models. And this all points to one thing, a massive reliance on the manager's skill. The success of your entire investment really hinges on the expertise of the person picking those loans. Okay, so given all those risks, doing your homework is absolutely essential. So I want to give you a toolkit. Here are 3 critical questions you should be asking any private credit fund manager before you even think about investing a single dollar. First up, this seems like a simple question, but trust me, the answer reveals a lot. If there's no public market price, how on earth do they decide what your investment is worth on your statement each month? Well, the answer is that most funds use their own internal models to calculate the value. It's called marking to model. Now, because these are just models and not real-time market prices, the value you see on paper can seriously lag behind what's actually happening in the real world. This can create a dangerous illusion of stability, making the investment look way less volatile than it truly is. All right, question number 2 gets at systemic risk. Let's talk about a crisis. What happens if the entire financial system just gets spooked and lending suddenly dries up everywhere? So even though these are private loans, they are not immune to the wider economy. A severe credit crunch can absolutely trigger a wave of company defaults right across the board.
And in that kind of scenario, a fund might be forced to hit the brakes. They might have to delay or even reduce investor payouts while they scramble to restructure all those struggling loans.
And the final question is just intensely practical. Let's get down to brass tacks. When a loan does go bad, and let's be real, some of them inevitably will, how much of your initial investment does the fund typically get back?
And the answer is, it depends. The structure of the loan itself matters immensely. For instance, if a fund makes senior secured loans, which means they're first in line to get repaid and the loan is backed by company assets, the recovery rate can be pretty high, maybe 60 to 80%. But if the loans are unsecured, with no collateral backing them up, that recovery rate can plummet to less than 20 cents on the dollar. This is exactly why the manager's expertise and how they structure these deals is so incredibly critical.
So we've walked through the alluring upside, the pretty sobering downside, and the critical questions you have to ask. And this brings us right to the final consideration.
Ultimately, it all boils down to this single question, and it's one you have to answer for yourself. Is the promise of a higher yield really worth the price of locking your money away for years and taking on all of these unique and very real risks?